Candlesticks show us where price moved, but CVD helps reveal why. In this video, you'll learn how to spot two powerful CVD divergences, absorption and exhaustion, and what they reveal about the underlying traders that are moving the market.
This video is for educational purposes only. Trading involves significant risk, and you may lose more than your initial capital.
To understand cumulative volume delta, we first need to clarify the difference between aggressive and passive market participants. An aggressive buyer is someone who executes a market buy order. By doing so, they cross the spread and buy at the current best available price, the ask. An aggressive seller does the opposite. They execute a market sell order, crossing the spread to sell at the current bid. These aggressive orders interact directly with passive participants, traders who provide liquidity by placing limit orders. A passive buyer places a limit buy order below the current market price. A passive seller places a limit sell order above the current market price. This means, when an aggressive seller sells, they are hitting the best available bid, which corresponds to the nearest passive limit buy order in the order book. When an aggressive buyer buys, they are lifting the best available ask, which corresponds to the nearest passive limit sell order. It's also important to note that stop orders, such as stop losses, are not passive orders. They do not rest in the order book. Instead, they are simply rules to the trader's broker that trigger a market order at a certain price, and therefore count as aggressive participation. This interaction between aggressive and passive orders is what drives price movement. For example, if there are more aggressive buyers than passive sell orders available to absorb them, price will move upward to locate additional liquidity. Conversely, if passive sell orders are sufficiently large, aggressive buyers may be fully absorbed at the current price. When this happens, price does not move higher, often causing aggressive buyers to run out of steam, resulting in a reversal. Ultimately, price moves due to the imbalance between aggressive buyers and sellers, as long as there are not too many passive participants standing in their way. Cumulative volume delta simply measures that imbalance. Now that the distinction between aggressive and passive participants is clear, it becomes easier to understand what cumulative volume delta actually measures. Cumulative volume delta, CVD, tracks the ongoing difference between aggressive buyers, contracts traded at the ask, and aggressive sellers, contracts traded at the bid. Each period's net difference, known as volume delta, is added to the previous periods, creating a cumulative running total. For example, at 2 p.m., if 150 contracts trade at the ask and 100 contracts trade at the bid, the volume delta for that period is plus 50. At 3 p.m., if 100 contracts trade at the ask and 80 trade at the bid, the volume delta for that period is plus 20. Because these deltas accumulate, the CVD reading at 3 p.m. would be plus 70, simply the sum of the previous deltas. In most futures markets, CVD typically resets to 0 at the start of each new trading day, which begins at 6 p.m. New York time. This is the most common and practical convention, although you can choose a different time and frequency if you wish. With both market participation and the mechanics of CVD now defined, the next step is understanding how to interpret cumulative volume delta in real market conditions. Importantly, CVD should not be used in isolation. Its role is to act as confluence, a tool that confirms an order flow narrative at a key level or area of interest. The most effective way to interpret CVD is through its divergences with price. Under normal conditions, CVD and price tend to move together. More aggressive sellers generally lead to lower prices. More aggressive buyers generally lead to higher prices. So, meaningful information is revealed when price and CVD no longer move in alignment. These moments indicate either absorption or exhaustion, which can signal potential reversals or continuations. The first type of divergence is absorption. This example focuses on absorption of buyers, which produces a bearish signal. Consider a market where price forms a high, a low, and then a lower high, while CVD forms a high, a low, and then a higher high. Here, CVD pushes to a new high, but price does not, creating a clear divergence. Looking deeper, aggressive buyers dominate, pushing CVD upward and pulling price with it. After a brief pause, aggressive buying continues, driving CVD higher again. However, price fails to follow this second push. This indicates that passive sellers are placing sufficient limit orders at that level to absorb all incoming aggressive buying. This is a bearish signal because the aggressive buying pressure was not strong enough to overcome the passive sell-side liquidity. The market is showing buyer absorption, suggesting a likely downward move. Absorption can also occur on the sell side, producing a bullish signal. Imagine a market where price makes a low, a high, and then a higher low, while CVD makes a low, a high, and then a lower low. Again, CVD reaches a new extreme, but price does not. In this case, aggressive sellers dominate, driving CVD lower and pulling price with it. Selling then resumes, pushing CVD to a fresh low. Yet price refuses to follow, holding a higher low. This shows passive buyers are stepping in with limit buy orders and absorbing the aggressive selling. This is bullish. The market reveals seller absorption, suggesting that selling pressure has been fully absorbed, and buyers may soon regain control. The second major type of divergence is exhaustion. This example looks at exhaustion of buyers, which forms a bearish signal. Picture a market where price continues to push higher, forming higher highs, but CVD fails to make a higher high. This indicates declining buyer participation. The rally has reached a point where aggressive buyers have largely completed their activity. There are no more buyers left, i.e., they have been exhausted. Price may still rise slightly, but primarily because there are not enough passive sell orders to limit the movement. This lack of buyer participation reveals weakening buy-side pressure and typically signals a bearish shift. Exhaustion can also appear on the sell side, producing a bullish signal. Consider a market where price continues to fall, forming lower lows, while CVD fails to make a lower low. Seller participation is drying up. Aggressive sellers have already executed most of their market orders and are becoming exhausted. Price may still drift lower temporarily, but mainly due to a lack of passive buy orders absorbing the remaining sellers. This signals clear seller weakness and can precede a bullish reversal. These divergences are generally most reliable on lower time frames and when they occur over a short time window, typically within 30 minutes or less. Again, CVD divergences should act as confirmation within a broader order flow context, not as a standalone trading strategy. This example shows a clear case of bearish absorption divergence on the ES Futures 1-minute chart. The Delta Hawk CVD Indicator is used here to automatically identify the divergence, but the same structure can be seen using any standard CVD indicator. Price is initially trending upward, forming higher highs and higher lows, and CVD is moving in alignment. However, price then forms a lower high. At this point, it is important to check whether CVD is confirming or contradicting this move. CVD shows the opposite behavior. It forms a higher high. This creates a divergence. CVD shows stronger aggressive buying, but price fails to move higher, indicating that passive sellers are absorbing the aggressive buying. Once aggressive buyers lose momentum, sellers regain control and price moves lower, completing the bearish absorption pattern. In this example, price forms a lower low, followed by a higher low. As always, the next step is to assess whether CVD is behaving in the same way, but CVD forms a lower low, which creates a clear divergence. CVD indicates that aggressive sellers outweigh aggressive buyers, yet price does not follow the selling pressure. This tells us passive buyers are absorbing the aggressive selling at that level. When sellers eventually lose momentum, buyers step in and price moves higher, completing the bullish absorption divergence. This example demonstrates bullish exhaustion divergence. The market is trending upward and CVD is rising alongside it. Price then breaks a prior low, forming a lower low. From price action alone, this could appear to show seller strength. However, CVD does not make a lower low. This reveals that the move down is not supported by aggressive selling. Aggressive sellers are not driving the new low. Instead, aggressive buyers still outweigh them. As a result, the trend resumes upward, making the downside break a form of fake-out. In this final example, price is trending downward, but then forms a higher high. Checking CVD reveals that it fails to make a higher high, creating a bearish exhaustion divergence. Here, CVD shows that sellers remain in control, or that aggressive buyers are simply not participating strongly enough to sustain a reversal. The move upward is therefore likely a temporary counter-trend push, driven by a lack of passive sell orders, rather than genuine buyer strength. The trend then resumes downward in favor of the aggressive sellers. This video introduced the core concepts behind cumulative volume delta and demonstrated how it reveals the interaction between aggressive and passive market participants. It also outlined the two primary forms of CVD divergence, absorption and exhaustion, and showed how each can provide insight into potential shifts in market direction. The next step is to apply this knowledge, open your charts and study these divergences across different sessions and market conditions. Backtest them carefully and always combine them with additional confluences before incorporating them into a live trading plan. For those who want to use our free Trading View indicator that automatically highlights these divergences, a link is available in the description. Thank you for watching. If this breakdown was helpful, please consider liking the video and subscribing for more order flow trading content. Feel free to post any questions in the comments, and they'll be answered as soon as possible. See you in the next video.